first quarter of 2016 started with a bang. Stocks plunged in January and fell further in early February, and a bear market seemed a possibility. That was the opportunity for bonds to shine, with long-term treasuries benefiting from a flight to safety. However, within a number of weeks, stocks staged a great comeback, with the Dow rising more than 7% in March alone, and the S&P 500 and NASDAQ close behind. From a longer-term perspective, however, some questions remain. This quarter represents the 7th year of recovery since the stock market lows of March 2009. The Dow and S&P 500 reached all-time highs late last spring, which, with the Russell 2000 representing U.S. small caps, peaking last June. Since that point, we've experienced two corrections, one last summer and the other this winter. And while the Dow and S&P have recovered pretty well from each of those corrections, none of those indexes have been able to set new highs over the last 10 months. The Russell 2000 in particular is down about 15% from its high, although the Dow and S&P are only off 3 to 4% off of their highs. While we certainly could see new highs achieved this year, the length of the recovery to this point calls into question how long it can last. The U.S. economy achieved net job gains in all 3 months of the quarter, with February and March each over 200,000. Participation in the labor force rose during the quarter, resulting in headline unemployment at 5% in March, and the U6, which includes both unemployed and underemployed workers, at just shy of 10%. Mortgage rates dropped during the quarter, with the 30-year fixed rate to under 4% and the 15-year mortgage down to 3%. U.S. corporate profits dropped 3% in 2015 and seemed likely to extend that decline into the first quarter. Inflation also ticked upward but remained relatively tame. Commodity prices were mixed during the quarter. Precious metals rebounded, with gold rising over 15%. After declining for a number of months, the price of oil finally started to rebound as well. However, base metals and a number of soft commodities like rice and coffee moved the other direction. Arguably, the most reassuring development for Wall Street occurred in March, with the Federal Reserve not only refraining from raising interest rates, but also scaling back its forecast for rate hikes across the rest of this year. The consensus forecast is now for 2 rate increases this year rather than 4. Other central banks were easing during the quarter, with the Bank of Japan even cutting a benchmark interest rate below 0. The European Central Bank also strengthened its stimulus efforts with increased bond purchases and decreased interest rates. The Chinese economy continued to be a sensitive area in the first quarter. Standard & Poor's is now projecting a 6% annual growth rate for the Chinese economy over the next 3 years. While that's still a great rate of growth, it is lower than the last several years. This was reflected in China's stock markets, which peaked in the middle of last year and continued to fall in the first quarter. Most Asian and European stock indices struggled as well. So the first 3 months of 2016 definitely felt a bit like a roller coaster, but ended with some solid weeks for stocks. Hopefully that strength will continue and carry them to new highs in the second quarter. For now, we at LifePlan hope you enjoy a wonderful springtime and look forward to talking with you later this quarter. Have a great day.